Hey everybody! LMND is a new insurance company that is being hailed as a disruptor to the insurance market. Their CEO, Daniel Schreiber, claims to have rethought insurance from a first principles basis. As an actuary in the property and casualty field, I'm curious to see whether LMND is truly a threat or not. In this video, I'm going to break down LMND using said first principles and determine whether or not it can truly become the disruptive force it plans to be. First, let's take a look at what the insurance product is. The insurance product is an agreement to cover damages to the policyholder in the case of an accident. In the property and casualty space, this policy will typically cover losses related to an automobile or property. In the case of LMND, their focus is initially on renters coverage, homeowners, and pet insurance. For each type of insurance, insurers will specify what type of losses the policy will cover. For example, in auto insurance, the policy would cover your injuries, third-party injuries, your vehicle's damages, and many more. These coverages are typically the same amongst insurers for several reasons. If the line of business is regulated, the coverages are determined by legislation. If unregulated, companies will typically have similar definitions of coverage due to competitive reasons. Now, there may be some differences in terms of risks being covered, depending on the company's risk tolerance. For example, a company may specialize in high-value homes, whereas another may refuse to write it entirely. Given that LMND is not focused on being a specialty writer, the actual insurance product that LMND offers should be fairly similar to existing incumbents in the insurance world. Hence, there should be no advantage when it comes to the product itself. The next major component of insurance is the pricing. Since the insurance product itself is very similar, price is a very important differentiator between products. Depending on the risk characteristics of the policy, a price is determined usually by an underlying rating algorithm. The rating algorithm is a formula that tells you how to calculate the insurance premium. This rating algorithm is constructed using historical loss data and using statistical methods to determine which risk factors are most useful in predicting future losses. In order to create an accurate model, this depends on having large volumes of loss data. This is due to the fact that the model needs to distinguish whether or not these patterns happen by random chance or if there is true predictive power. The more risk characteristics you want to use, the more data you'll need to ensure that there is sufficient data for each small segment. Even the most sophisticated modeling techniques will struggle to make accurate predictions without sufficient data. As a result, the insurance pricing game is won or lost by having more or better data than your competitors. LMND claims to be collecting hundreds of times more data than competitors, and as a result, they claim their models have much higher predictive power. This claim is questionable in my mind for several reasons. First, insurance companies have a much larger book of business and many more years of data than LMND has. Second, unlike with other industries, loss data takes time to accumulate. Not only do you need to write a sufficient volume of policies, but they have to have losses occur in order to make predictions on them. After the loss occurs, it may then take even more time for the customer to report the claim. This is especially true for injury-related claims. What I believe LMND is referring to is regarding data collection for their app usage. They are monitoring every single click and interaction that is occurring with the app and trying to draw causal relationships to losses from this. However, many other insurers also have apps available for their services and are also using similar techniques. Whether it is analysis of call data, app usage, or image information, these are all data points that the insurance industry is aware of. For argument's sake, let's say that LMND is somehow collecting additional data from their app that other insurers are not. There are still two remaining challenges. First, is the data being collected predictive in nature? Second, they still need a high volume of claims information in order to parameterize their loss models. If they don't have sufficient losses, their model is unlikely to be able to draw the correct conclusions. This is magnified by the fact that they are using highly granular data segments and require even larger volumes of losses to parameterize their models. This will improve over time as LMND scales. However, for each new line of business that LMND enters, this problem starts from the beginning again. This is due to the fact that each new line of business requires a new set of data collection. On the flip side, for incumbents, they already have a wealth of data that they can draw upon. LMND made a smart move targeting renters and pet insurance first, as these are smaller value products, and incumbents are unlikely to spend the same resources creating sophisticated models for these markets. However, it will be very challenging for LMND to break into the auto and homeowner markets. The last major component of insurance is service. This can be broken down into two major components: sales and claim servicing. Sales is a three-step process of first collecting the data from the customer, providing the quote, and then underwriting the policy. Each of these steps benefit heavily from having a well-designed background infrastructure and digital distribution. Lemonade's well-designed infrastructure allows it to process the information quicker and leads to it to being able to more quickly provide quotes. Current insurers have a number of challenges with their existing legacy systems that results in slow quoting times. In terms of underwriting, currently, insurers have large volumes of staff to review these policies. While there is incremental value in humans reviewing these policies, the additional speed and expense savings from having this process automated could be immense. In terms of the sales distribution, while in many industries, a digital distribution would be a huge advantage, in the insurance industry it is less clear. In theory, having insurance distributed digitally can create major expense savings on either the sales force or from brokerage fees. However, digital distributions are not unique to the insurance marketplace, and they have their own challenges. One of the major challenges is the quality of business. The ease of quoting results in many price-sensitive and high-risk segments to shop around using the digital distribution. In the past, digital insurers have trouble managing their profitability because their books are full of businesses that they are underpriced for. In order to succeed, the company will need a very strong rating algorithm to protect their profitability. This will always be a challenge whenever Lemonade looks towards breaking into new segments. In terms of claim servicing, Lemonade claims to have dramatically shortened the claims process. At this point in time, Lemonade is primarily based on renter's insurance, which has less complex claim types. Some claims, such as injury claims, usually requires more experienced claim adjusters to make an assessment. I'd like to see how Lemonade handles more complex claims before declaring them superior. As well, I'd like to monitor how their claim servicing impacts their loss ratio. While Lemonade's service in both sales and claims represents a massive improvement over other insurance companies, I do not believe this advantage is enough to disrupt the industry. While sales is efficient, consumers usually go through multiple insurance quotes before making a decision. In terms of claim servicing, the majority of policyholders never end up using this service. As a result of these two factors, most consumers will base their purchasing decision primarily on price. Now, one possibility is that the efficiency in service drives down lower expenses and therefore could result in lower future insurance premiums. If they were able to do that, then Lemonade may start to gain an advantage. In summary, when looking at the product, price, and service, Lemonade only has a clear advantage in service. I like that they are making major improvements on that front, but I see Lemonade more so having improved and refined several key elements of insurance rather than a complete reimagining of the product. As well, I see Lemonade's data architecture as a strong competitive advantage, but I do not see it as being a permanent moat that would prevent incumbents from producing a comparable product. I think there are several major mobility trends that represent even larger of a disruption to the auto insurance market, and I do not see Lemonade in the same scope of these trends. Overall, I think Lemonade has some important advantages over the incumbents, but nothing that would stand out as having a long-standing moat. It could eventually grow to be a major competitor and drive some important changes in the industry, but I do not see it changing the fundamentals of the industry. As a result, I think Lemonade is a good company, but not a disruptor. Let me know in the comments below, what are your thoughts now on Lemonade as a company? Do you still see it as a disruptor? And if so, why? So that's it for today's video. Thanks so much for watching, and I'll see you next time.